Wednesday, December 29th, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at the Fed's balance sheet to see whether it's really tapering up until the latest week that it's published its numbers since the beginning of December. We're going to try to dispel the fallacy that QE is just an asset swap. I hear people using that term a lot to justify that QE is deflationary. And we're going to quickly go through an article this morning that's come out in the independent newspaper in the UK to show you how deflationary QE has been for the UK. So before I briefly go over what an asset swap is and what derivatives are, and I'm not going to go into derivatives very deeply, but I do have a playlist called Derivatives File, which I've been compiling for years. It's got 19 videos there. And if you want to know what derivatives are, go there and listen to some of my videos. I worked in the derivatives market for 20 years in the city of London. So let's go to the basics of a derivative. In the financial markets, there are what people call different assets. We've got commodities, we got equity, stocks, we got fixed income, bonds, and we've got currencies, foreign exchange, basically cash. You may hold US dollars, you may hold British pounds. It's an asset in a different currency. So those are the main assets out there. And I think if you add them all up, you're near like 300 trillion in global financial assets at the moment. It could be a little less or more. So what are derivatives? Well, derivatives, they started out in the modern day financial system. They started out in the 19th century when producers and farmers were trying to hedge against the weather, natural disasters, and they started the Chicago Board of Trade, the Chicago Mercantile Exchange, to bet on prices of agricultural goods in order to lock in prices so that farmers could protect their cash flow. And that's how it started. The derivatives, they're just bets. And of course, you get also speculators trading in those markets. And they don't have an axe to grind in terms of the underlying asset. They're just betting on the price. And it's usually highly leveraged. So speculators leverage. What does that mean? Well, they put down $10 and they control $100 worth of wheat, for example. In the 20th century, really, we've had the growth of financial derivatives, and it only started in the 1980s. And why is that? Well, because prior to the 1980s and 1970s, let's say, financial assets, currencies, interest rates were relatively stable because we had a real monetary system based on gold and silver. So it was relatively stable. People didn't need to hedge. So the financial derivatives have grown as a result of the fiat currency system. And it's mushroomed. Why has it mushroomed? Well, because it's gotten out of hand. And it's also used to drive the underlying price of the assets, be they precious metals, be they bonds, be they currencies. Derivatives can be used to drive the underlying price. It's a little bit like the tail wagging the dog because derivatives should really be small, but it's grown so much because of the speculation and because of the fact that central bankers have realized that they need to keep prices artificially manipulated. And the best way to do that is through derivatives. And I would argue that the increase in central bankers' balance sheet, be it the Fed and the other major central banks, from about 3 trillion before the '08 crisis to over 30 trillion right now, that increase in the balance sheet has been used to keep this derivative Ponzi going. And the major users of this derivatives are the bankers on Wall Street, City of London, the hedge funds. Yes, corporates do use it to hedge, but that's a minuscule amount of derivatives. The other very important thing about derivatives, and this is where we come to asset swaps, and I'll come to asset swaps in a minute and what they really are. Derivatives, being bets on underlying securities, are not placed on the balance sheet. They're off-balance sheet transactions, so they're very opaque, and that's why they almost brought down the whole system in '08. Just watch The Big Short and see the mushrooming of derivatives bets. So I said that derivatives are a bet on the underlying security, for example, but these bets can get so big that they mushroom the underlying market. So it's very dangerous. So I Googled asset swap, and I knew what an asset swap was, but I wanted to show you what it is. And this is from corporatefinanceinstitute.com. And it says, an asset swap is a derivative contract between two parties that swap fixed and floating assets. So what does that mean, fixed and floating? Well, basically, it's a bond, let's say. Let's say I buy a 10-year bond with a fixed rate, and Billy buys a floating rate bond, right? The interest rate floats with yields. So if the bond market prices start going down and yields start going up, Billy's floating rate bond will adjust to the rising rates, and he's going to get, his income will go up because it's adjusted. My income, though, in terms of yield, will go down because I'm only getting the original yield, and if yields go up, I'm missing out on the rising interest rates. So I go to Billy and say, Billy, do you want to swap your floating rate for my fixed rate? And he might think, yeah, fine, but you're going to have to pay me something because I think interest rates are going to keep rising. So we swap that. But I don't sell my fixed rate bond, and Billy doesn't sell his floating rate bond. We just make this contract outside our balance sheet. And I'll be getting Billy's floating rate payments, and he'll be getting my fixed. And usually there's a cost to that involved. And there's also a cost involved in terms of counterparty risk. The banker that is in between, or the dealer that's in between Billy and I performing this asset swap, they will know my credit rating and Billy's credit rating. So that's an asset swap, and it doesn't show up on the balance sheet. So QE. So what is QE? Well, QE is when the Federal Reserve or other central banks create reserves out of thin air. Reserve is just another term for money, but within the banking, the central banking wholesale system when they deal with other banks. So they create money or reserves out of thin air, and they go out and they buy bonds. They don't swap. So they exchange cash basically for treasuries and mortgage-backed securities. Yes, they're doing ETFs now as well. So that cash that the Federal Reserve creates, or you want to call it reserves, okay, reserves. flows into the bank's balance sheet, and the bonds that the primary dealers who have probably bought those bonds from the US Treasury. So basically, the Fed is buying it from the Treasury indirectly. Those bonds are sent to the Federal Reserve, and they go onto the Federal Reserve's balance sheet. So it's not an asset swap. It's not a derivative. And if QE was an asset swap, the Fed's balance sheet would still be just under $1 trillion like it was before the '08 crisis. So how come it's almost at 9 trillion now? Well, because they've been buying assets. They haven't been swapping assets. And how do they buy assets? Well, with more and more reserves or money really created out of thin air, or really fiat currency. So I hopefully that dispels this notion that the Federal Reserve is doing asset swaps and it's deflationary. The other thing I would say, the Federal Reserve announced on November 3rd that they'd be doing tapering from the beginning of December. At the time, the balance sheet was at 8.574 trillion. Right now, the latest data for the balance sheet has the balance sheet at 8.790 trillion. So the balance sheet is increased by almost 216 billion since the beginning of November. And if you look at since the beginning of December, you see here December 1st, balance sheet was 8,650. That's billion, so 8.65 trillion. And the latest data here, updated on the 23rd of December, balance sheet was at 8.79 trillion, an increase of 140 billion. They told us they were going to taper by 30 billion. They're supposed to be doing 120 billion a month. So they've done already 140 billion here. So is that really tapering? And I know we need to wait for the latest data. I guess that will be for up until today, the 29th. That hasn't come out yet. So it will be interesting to see if the balance sheet drops back by 50, let's say 50 billion. That would make the QE since the beginning of December 90 billion, which would mean that they are tapering by 30 billion. But right now, they've already done 140 billion. So much for tapering. And with that, before we look at the markets, just for those of you who say that QE is deflationary, that we haven't seen rising prices, there's no inflation. Well, look at this article from The Independent. They use the term cost of living, but it's the inflation that's devalued the currency, and the inflation, of course, is created by government. How did the government create inflation? Well, they closed down the economy last year, and they spent 15% more than they took in, the budget deficit. They've created jobs. So we've become, in the UK, a nation of jabbers or vaccinators, and a nation of testers. There's been a lot of jobs created in those sectors. A lot of jobs, of course, in productive sectors have been destroyed. So is it any wonder that we are seeing a catastrophe looming in 2022 as soaring bills and taxes blow £1,200 hole in household budgets? That £1,200 is per year, of course. That's going to hurt. It's not going to hurt the banker in the city or the billionaire. £1,200 a year for them is nothing. But for the average worker, it's a lot. It's going to, throw a huge spanner in the works. And one of the reasons I'm showing this article is because people out there still giving out this information that QE is deflationary. And if it was deflationary, the currency would be doing really well, and consumers would have a lot of money out there, they wouldn't be suffering from rising prices, and their cost of living would be going down, because that's what deflationary is. But yes, unfortunately, people have been fooled into thinking that there's no inflation, that rising prices for some reason are something, how can I say, something, a mystery, right? But to you and I, it's not a mystery. We know that rising prices come as a consequence of counterfeiting. And who does the counterfeiting? Well, it's the government and the central bankers and the bankers. And they create this funny currency out of thin air. Can you imagine if you and I could create funny currency out of thin air and start buying things? Well, prices would rise. It would disrupt everything. And that's what they've done. But it says here, Jill Rutter, senior research fellow at UK in a Changing Europe, told The Independent that there are a few levers for the Treasury to pull in the short term. Instead, the Chancellor will be hoping that inflation eases, before the Bank of England pushes interest rates up higher, which could dampen down economic growth. So do you see how that doesn't make sense? Because it's the Chancellor and the Bank of England that have created the inflation that's resulted in the rising cost of living. So how can the Chancellor hope that inflation eases? They're the ones that have created the inflation. So with that, let's quickly look at where the markets are this morning. It's 5 to 9 a.m. London time. We've got spot gold at 1803. It's down about $3. High has been 1808, low 1802. Yes, yesterday we traded up to 1820. So the short-term moves are a little frustrating, but I think medium to longer term, gold and silver are starting to move up quite nicely. We got up to almost 2350 in silver, and then we came off, of course, when the US came in. Some people have lost maybe hope that gold and silver can ever go up, because they see every time the US comes in, the Exchange Stabilization Fund comes in and sells gold and silver, the paper, of course. But as I said, if they were able to control the price of gold and silver, we'd still be at $35 an ounce for gold and below $2 for silver. So I'm not concerned. Patience is still required. What about silver this morning? Well, it's up 12 cents, 0.5%, 23.13. The Dow futures up 49. NASDAQ futures up 53. S&P future is up 8 points. The FTSE is up 5. That's 74.54. To the Forex market, sterling is down about 0.1% at 134.22. The euro is down 0.2 at 112.85. The dollar is up slightly versus the yen, just below 115, and the dollar is down 0.1% versus the yuan at 636.60. Aussie dollar is up slightly at 72.33. The dollar is down slightly versus the Canadian dollar, 128.16, and the Kiwi dollar is unchanged at 67.95. To the commodities, we've got crude oil up slightly at 75.91. We've got high-grade copper down 0.5% at 440.86. And to finish off, we're going to look at the 10-year yield. So the 10-year yield is unchanged at 1.48%. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.